Welcome to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. We're here inside Bloomberg headquarters in New York.
This week, we look at the turmoil surrounding President Trump and what it may mean for the 2020 election.
Plus, WeWork's family affair, how the company's culture caused it to stumble.
And BusinessWeek talks. Delta CEO Ed Bastian keeps climbing.
Well, first up, let's start with something Carol's endured me blathering about a lot. It's a private equity takeover of the finance section.
I've enjoyed it, and I've learned a lot as well. It is this week's cover story. You live in private equity's world. Bloomberg BusinessWeek editor Joel Weber joins us now. And Joel, this is a reminder, private equity touches us in so many different ways.
Yeah, that's right. We kind of couldn't stop listening to Jason go on and on about this, as well as many other people in the newsroom. And when we all kind of got together about all the different ways that private equity touches us, we realized that there was a bigger story here, which was in the last decade, since the financial crisis, nobody won this decade as much as private equity did.
And now we've got some questions, and that's really how this story shaped up, and you really posed them to a lot of us in the newsroom.
It really started as like, let's just ask questions about private equity. And from there, we realized there were a number of different places we want to go. The fact that DC, the private equity industry, has this thing called carried interest. So far, that's been untouchable, but yet if things change in DC, we might see carried interest change.
Right, and we did see a ton of lobbying in terms of the private equity firms. They're spending a lot of money.
Tons of money. So, and then we also talked about returns, right? This is something that everyone wants, big returns. We're in a world without yield anywhere. How do I get an ROI? Private equity promises that, but it's not always what it seems.
Right. Well, and I think this notion that so many big institutions have been pretty happy from a return perspective, it's grown so massive, but in that scale, with that size, there are a lot of consequences, some intended, some not.
That's right. And for the average consumer out there, you don't know all the different ways that private equity can touch your life, from the cups of coffee that you drink, to your pets, to even like if you have a pension, like the whole point of a pension is like you got to get the returns, and private equity is one of the places that people turn to do that.
Well, and one of the things we've talked a lot about is their influence around the world. The individuals who run this firm, they are in the midst of the most important conversations
That's right.
of our time.
Donald Trump's picking up the phone to talk to Steve Schwarzman about China. That reveals something else that we also noticed, which is private equity industry dominated by men.
Right, exactly. And I feel like I love the coverage, because I do feel like we need a little bit more transparency about the industry, right?
So that's kind of what we set out to do and why we made it this week's cover.
All right. It's a great cover story and a great bunch of stories. Joel Weber, thank you so much. We'll have more on the world of private equity a little bit later on. We turn now, though, to the week so far in politics.
An ongoing impeachment inquiry, subpoenas for Rudy Giuliani and the State Department. And as 2020 looms, that big election, Elizabeth Warren taking a step forward in some polls.
Bloomberg's BusinessWeek national correspondent Josh Green joining us now from Washington. So, Josh, what a week it's been. And I think we're all starting to figure out, will this have ultimately some kind of implications for the 2020 elections?
Well, I think almost certainly it will. It's funny, every week we sort of finish up by saying, geez, what a week in Washington. And yet this one really stood out apart from earlier ones because we now have a fast-moving Democratic impeachment inquiry that is very serious, moving forward very quickly, has ensnared the president and a lot of his top cabinet officials. And Democrats certainly seem to think that this week that now they have momentum going forward, and there's a good chance that they're going to impeach the president. Now, what effect that will have on the election, on the markets, nobody has any idea. The big news affecting markets this week, I think, was more the slowdown in manufacturing data and the rising chances of recession than anything involving Donald Trump. But as I have learned through hard experience in Washington, you never assume anything. Next week could be different, but for this week, impeachment, I think, took center stage and is just dominating everything in Washington.
So, Josh, I got to ask you, as Elizabeth Warren has been ascendant, I think back to that cover story you wrote not too long ago, where you essentially reminded all of us, hey, don't sleep on Elizabeth Warren here.
No, I've been bullish on Elizabeth Warren since before it was popular. In fact, I pitched that Bloomberg BusinessWeek cover story back in September when she was in single digits. Got some quizzical looks from my editor, but part of the reason we did that story was because Warren has a lot of candidate skills. There's a lot about what she's doing that appeals to grassroots Democratic voters. I see it on the ground when I travel with her in Iowa, in New Hampshire. Now I think we're seeing that reflected in the polls, and especially as Joe Biden has started to stumble and slip a little bit. Bernie Sanders this week had a health scare. Warren is the one who has now emerged as, we're calling her in Washington a co-frontrunner. But if you look at the polls that came out this past week, she may be a narrow frontrunner overall for the Democratic nomination.
Well, and that's what I just want to follow up on, because you've spent a lot of time on the campaign trails with various candidates over the years, Josh. I mean, Joe Biden, this story, every time you talk about President Trump and the impeachment inquiry, Joe Biden also comes up, and of course his son. What does this mean for him? Is he done in terms of this campaign, or that is too soon to call?
No, I don't think Joe Biden is done by a long measure. Look, it's interesting. Trump, despite the fact that he's gotten himself in real trouble here and launched an impeachment inquiry, did this in part because he was trying to advance a story that he believed would damage his chief rival, Joe Biden. We can see from poll numbers that it's put Trump in some kind of jeopardy. We don't yet see in the poll numbers, though, that it has cost Biden. Politico came out with a poll this past week showing that 40% of voters still consider Biden to be the most electable Democrat. That's actually up a tick from the last time Politico did a poll. So it isn't hurting Biden yet. And he's very much still not just a viable Democratic candidate, I think, but certainly one of the two most likely to win the nomination at this standpoint.
Josh Green in Washington, thanks so much.
Well, coming up, Rudy Giuliani is at the center of the president's impeachment inquiry.
And a weapons manufacturer backed by Peter Thiel, staffed by a group of prominent Trump supporters, is selling attack drones to the U.S. government.
This is Bloomberg BusinessWeek.
Welcome back to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. Join us for Bloomberg BusinessWeek every day on the radio from 2 to 5 p.m. Wall Street time.
You can also find us online at businessweek.com and on our mobile app. In our politics section, President Trump's personal attorney, Rudy Giuliani, has not been formally charged with any wrongdoing. His actions, though, are at the heart of the impeachment inquiry against the president.
Bloomberg BusinessWeek Stephanie Baker has been following this story closely. She joined us from London.
This House subpoena for communications and documents from Rudy Giuliani will be central to the impeachment inquiry. They have asked for documents and communications related to a long list of Ukrainian politicians and businessmen that he has done consulting contracts with, as well as politicians that he met with in the run-up to that crucial July 25th call between Trump and the Ukrainian president, Volodymyr Zelensky, which is at the heart of the impeachment inquiry. He has resisted, or he seems to be resisting efforts to disclose those communications. He hasn't said officially whether or not he will comply with the subpoena, but he has intimated that there are attorney-client privileges at stake here. And I think that's going to be a difficult one for him to fight, given that much of what they've asked for doesn't really pertain to his role as a lawyer for Donald Trump.
Well, and that's what kind of complicates this whole situation, as you write about. I mean, his role within the White House, it's ambiguous, right? Official, not official. There are times he said he spoke, with understanding or an okay from the State Department. It's his role there in the White House. It's a weird one.
Exactly, and I think that's why this one will be so fraught. He's cycled in and out of the White House wearing multiple hats. While he was defending Trump in the special counsel's investigation into Russian interference in the 2016 election, he was wearing his hat as Trump's personal lawyer, unpaid. Yet at the same time he was doing that, he was continuing with his private security consulting work. And then later, when Mueller's report was released, we've learned that he was acting as effectively Trump's shadow diplomat. making trips and making overtures to Ukrainian prosecutors, as well as Ukrainian aides around the Ukrainian president. And so whether or not he'll be able to withstand this subpoena and effectively fight it off really depends on which Rudy are we talking about? What hat is he actually wearing? And that'll be interesting to follow.
What are you hearing though about his ability to claim, hey, I am the president's lawyer, attorney-client privilege? How much, as you said, that maybe will not protect him going forward, certainly with the House inquiry?
He's been on cable news shows talking about this for months now, so it's hard for him to claim attorney-client privilege on issues where he's actually commented at length, in the press. And two, I think it's hard for him to argue, or he will argue it, but I think it will be difficult for him to argue that this really pertains to an ongoing, or at the time that it pertained to an ongoing legal matter for his client, Trump. At that point, the Mueller investigation had wrapped up, and his role was somewhat unclear. It depends on which lawyer you talk to. I think some of it may be protected by attorney-client privilege, but others, I think, won't. But the question is, will the House investigators have the stamina and the wherewithal to fight it out, and it could take a long time.
Stephanie, the other thing that's I think really interesting is, and you talk about it in your story, is that you mention, as you said earlier, that Rudy Giuliani, kept working, his business, right? He didn't stop any of those relationships or contracts. And some of those contracts included a few over in Ukraine, correct?
Yes. So I wrote a story for BusinessWeek about Rudy Giuliani's security consulting business and how he was continuing to do that while serving first as Trump's cybersecurity advisor and then as his personal lawyer. And he has continued to do that both in Ukraine. I think the last meeting he had on that Ukrainian security consulting contract was in March 2018. It may have gone on further than that. We don't know. But he's continued to do business around the world. And that is the subject of this House subpoena. They want records of his business dealings with these Ukrainian businessmen and records of any payments he has received.
So here's a story that's got a little bit of everything in it. It's in our technology section.
It's one of tech's most controversial startups. It's founded by a 27-year-old gamer. It's backed by one of President Trump's favorite billionaires, and it makes drones that destroy drones sold to the U.S. military.
Here's Joshua Brustein with that story.
The company is called Anduril, and it describes itself as aspiring to be the operating system of the Defense Department, which would basically be the software that kind of connects all the systems, whether those are surveillance cameras and dash cams on Jeeps or aircraft carriers. And so that's a big goal, but they've started kind of small, obviously, as you do. Their first deployment was actually with Customs and Border Protection on the Mexican border, which is in and of itself a pretty controversial place to start, and things have kind of taken off from there. Every ingredient of controversy is here. The founder of Anduril is a guy named Palmer Luckey. He founded, before this, the Oculus Rift headset. If you might remember, there was this little piece of technology industry lore that was bought. The company was bought by Facebook for $2 billion. And then right before the 2016 election, it came out that Palmer Luckey was secretly funding a group that was posting insulting billboards of Hillary Clinton. Suddenly he disappeared from Facebook and was eventually, he says he was fired. Mark Zuckerberg says he was not fired for political reasons. This actually came up in a congressional hearing. It's been sort of a snafu for Facebook. But so Palmer Luckey has this reputation as, kind of the Trumpiest person in Silicon Valley. Then he goes and starts a company whose first project is surveilling the Mexican border right at the time that the Trump border policies are really building up. And then that immediately fed into a debate about should tech be refusing to build things like this? And so then you had the Trump administration, which was already causing trouble in Silicon Valley, and border surveillance. And they just, really jumped into that.
One of the models of Silicon Valley of late has certainly been somehow being connected to Founders Fund and the folks associated in that orbit. How does that play into this story?
Yeah, so Founders Fund is the investment fund founded by Peter Thiel, who backed the president in the 2016 election. He originally started PayPal, but he's kind of the other technologist most associated with Donald Trump. And Anduril has an uneasy relationship with their connection to Peter Thiel. I talked to them a lot for this story. I spent some time in the office. They really wanted to say that Peter Thiel had nothing to do with this company. They say, look, Founders Fund is just an investment fund. He happens to be involved. They happen to be one of our investors. So they really want to play it down. At the same time, this fits into some of Peter Thiel's other business interests. Palantir is another software company that does very similar work.
Talk to us, though, a little bit about the work that they're doing, because the story opens up with one of the engineers, and he's playing around or showing how their drones can work. Tell us a little bit about that.
Yeah, so the actual project that my story mostly focuses on is a project they call the Interceptor, and it's basically a drone that autonomously will fly into other drones and knock them out of the air. The idea is that cheap hobbyist drones are being used in an increasing number of military ways. And
as we just saw in Saudi Arabia.
Although those were larger drones, but we have seen smaller drones used, in an assassination attempt, in various attacks, and they're very hard to deal with. So the idea is we could just build a bunch of small drones and put self-flying software on them and tell them anything that breaches this airspace, just ram into until it falls down. And they think this is a cheap and relatively easy solution to patrol, borders, military bases, and maybe other places. They've had discussions with selling these to commercial clients who have to defend oil and gas facilities. They have now put their foot slightly into another big hot button debate in Silicon Valley, which is whether we should build autonomous weaponry.
Right.
And if so, what should be in place to what regulations and so on should be in place. Anduril's answer is clearly yes, we should build autonomous weaponry. They refer to this thing as an autonomous or semi-autonomous weapon. At the moment, they do have some safeguards in place. It will identify the target and then show them a picture and ask someone whether they want to attack.
Right.
And full disclosure, Andreessen Horowitz, is also an investor, and Bloomberg LP is an investor in Andreessen Horowitz.
Correct.
So just to kind of put that out there.
Coming up, Delta climbing higher. CEO Ed Bastian talks about expanding the company's global footprint.
Plus, inside WeWork, how the company's family affair contributed to its IPO fallout. This is Bloomberg BusinessWeek.
Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. You can also listen to us on the radio on SiriusXM Channel 119 and on AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, in London on DAB Digital, and through the Bloomberg Business app.
In another edition of Bloomberg BusinessWeek Talks, we caught up with Delta CEO Ed Bastian. Delta, by the way, the stock, it has been outperforming its peers and doing a bunch of deals. We'll hear, though, from him in a moment.
Let's hear first, though, from Kaylee Line. She's here to talk to us about one region where Delta was doing great and now may need to make some moves.
May need to make some moves, and Delta is making moves. Delta just inking in $2.25 billion investment in LATAM Airlines, the biggest carrier in Latin America. And take a look at how Delta has performed in that region. It is a higher growth area of the world. And at one point earlier in this decade, Delta saw double-digit sales growth. But the pace of that growth has really slowed to just 1.5% year on year in 2018. Now that LATAM deal may make Delta the largest U.S. carrier in South America, replacing American Airlines airlines. So it may give them a chance to capitalize on that higher growth and maybe see that sales growth start to improve.
Right, and expand that global footprint. All right, Kaylee Lines, thank you so much. Delta, as you know, it is among the biggest global airlines and has invested heavily with international partners to strengthen those ties, and that includes that recent deal we just heard about with LATAM Airlines.
That's right. And Delta CEO Ed Bastian, he told us what it takes to win abroad and if he sees more consolidation coming in the industry.
I don't think you'll see consolidation in a meaningful way in the U.S. You may see it in maybe other parts of the airline market, not necessarily participating relative to Delta. Internationally, I do think you'll see.
Yeah.
Europe, you're already seeing it. You're seeing bankruptcies in Europe in terms of some of the European carriers. I think you'll continue to see some consolidation trends there. So on the global scene, that's where we've been investing. We've invested in a number of our partners,
right.
And really not consolidation. It's more to have influence within our global network of carriers. You'll see more of that from Delta potentially, but I don't think on the U.S. side you'll see that.
And what do those partnerships tend to look like now, and what might they look like in the future, either geographically, or are there new and different things that you can try to sort of create that family, as it were?
Sure. Well, one of the things I think that has not been successful in the airline world are the alliances. I'm self-critical of SkyTeam Alliance. I don't think we've brought a lot of great value to customers. I don't think we've brought a lot of great value to our member airlines. And we're going at this thing in a very different approach. We're going at it through Delta making bilateral investments in the most important partners. We own 49% of Virgin Atlantic. We own 49% of Aeromexico, the two closest carriers to us on either side of the country. We're invested in Air France, KLM. We've invested in Korean. We've invested in China Eastern. We've invested in Gold down in Brazil. And as a consequence, what you see is this network of influence that we're having within those companies. So those companies want to know what Delta has learned about operational efficiency and prowess and premium branding. We want to learn what it takes to win in those local markets. And then over time, while we can't own them in terms of whole-owned consolidation, we can have meaningful enough investment that we create an international network of carriers that will be uniquely tied where you have Delta as the centerpiece. That's our goal. And when you think about the long term, to think of Delta today, we serve 200 million customers a year.
Right.
If you add the customers from all those carriers I just mentioned, you're up to over 500 million customers a year that we serve. There's never been an airline network and an airline combination, forget consolidation, that delivers that kind of value across geographies. We have an opportunity to create that.
And so do you have people knocking on your door at this point saying, yeah, why don't you come over and sprinkle some of that magic dust on me?
There's a lot of questions going on and conversations at all times, and we answer every knock that occurs. Some we answer, some we say no, we can't do that. But there's a strategy here that's unique within the industry. The other groups are not doing that, and I think it's going to be an advantage for Delta.
So let's talk about your customers, both business and consumer. And you talked a little bit about it. I don't want to put words in your mouth, but like a little bit of weakness maybe from a business perspective from the global or from the Asian market sort of overall. Generally, businesses, it feels like, are a little bit cautious right now globally, maybe for geopolitical reasons. We certainly hear that through earnings reports from big companies. What do you see from your business customers?
I see a healthy U.S. consumer.
Okay.
We know the U.S. consumer drives 70% of the U.S. economy, and consumer demand is very, very healthy in the U.S. We just finished the busiest summer in our history by a meaningful amount. Revenues this year are up 7% year on year, which they were up also the year prior. We are within the Fortune 100. We are in the top quartile of growth companies within the Fortune 100, and we've been there the last couple of years. People don't expect Delta to be seen at that level of growth. We're seen as a mature company. I think we're seeing a lot of growth in travel.
You can see the full interview with Delta CEO Ed Bastian online at businessweek.com or listen to it via podcast. Get that in our Bloomberg BusinessWeek feed.
Up next, with over $4 trillion in assets, private equity, it's having a moment.
But where's the money being made? Who's making it and how?
This is Bloomberg BusinessWeek.
Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar.
Still ahead in this week's issue, our deep dive into private equity. We're also going to have a chat with investor Michael Tenenbaum. He's got a new book. It's all about the biggest risks he's ever taken.
Tillman Fertitta, he's also got a book out. He is the billionaire restaurateur and Houston Rockets owner. His book, Why You Should Shut Up and Listen.
You don't need to do that. Never. Just keep talking. We begin with the big picture on PE, though. It's this week's cover story and a special section takeover of the finance section. $4 trillion in assets. Private equity, it's everywhere.
Yeah, it is indeed. From your pet shop to your dentist's office. But how does private equity actually make money? Here's this week's BusinessWeek explainer.
Private equity ultimately isn't that complicated. Managers raise money from what are known as limited partners. Those are the pensions, sovereign wealth funds, and endowments that are looking for places to invest and some good yields. Next, the firm identifies a takeover target. The firm's managers take a chunk of the money they've raised, also called equity, and they pair that with borrowed money, in other words, leverage. That pays for the purchase. In an ideal world, the private equity firm owns the company for a few years and sells it for a profit. The firm distributes the winnings to the investors and, of course, keeps a healthy portion for itself. The investors agree to a structure known as 2 and 20. Every year, they pay 2% of the assets they put in to help fund the operations of the private equity firm. The firm's real money comes from the 20. After distributing 80% of profit to the investors, the firm keeps 20% for itself.
All right, so that's the mechanics of private equity. Let's talk a little bit more about why we're doing this right now. You've been involved in the coverage from day one.
Right, and this was important to do right now for a couple reasons. One, I think it's good to take a step back and realize the influence that these firms have, these individuals at the top of the firms have across the political landscape, certainly the economic and the business landscape, and also it has come to the political in a big way as we get closer and closer to 2020, and issues of inequality, issues of where the money's coming from, issues of who's making the money, all really important.
Right, a little bit more transparency in the industry is what we want. We're going to cover that, continue to cover it here on this edition of Business Week. Now, though, let's get to a story in the technology section about a company that was the subject of a recent cover story in the magazine. We're talking about WeWork.
It's one of the most followed and talked about companies, certainly, of this year. We kicked off 2019 with expectations that it would be one of the hot IPOs of the year, until it wasn't, for a variety of reasons, including governance concerns and a lack of profitability.
That's right. And with their failed attempt to go public, Bloomberg BusinessWeek's Ellen Hewitt tells us how WeWork's issues may have largely stemmed from the company's own culture.
Attention on this company has really evolved as it has become bigger and bigger. So like you said at the beginning of 2019, when it got this round of funding from SoftBank that valued it at $47 billion, all of a sudden it was this huge company. And as it prepared to go public, which we learned about in April, then I think that's really when people started looking at it and thinking like, is this company ready? And really anticipating the S1, which came in August, which I know was a very exciting day for me. And then it feels like at each turn there's more that's revealed. And there aren't huge surprises for someone who's covered the company for so long. I think the culture has been pretty consistent, but it has been interesting to see how public investors or public potential investors have viewed some of the conflicts of interest, the corporate governance structures, the personalities at the top of the company, and not always reacted very favorably.
So family was a big element at this company, and ultimately it was a big part of its undoing. How did all of this kind of seem to go under the radar for such a long time, Ellen?
So it's interesting. There's kind of two ways to look at the role that family plays in WeWork. So this has always been a company that's about communal spirit. Remember they had community adjusted EBITDA was one of the financial metrics that they used in an earlier financial document. They took it out for the S1, but it's been part of their ethos. They talk about life is better together. They explain, sort of make a life, not just a living. They really want to bring work and life together. And I think that ends up blending personal and professional. And then separately, the people at the top, this is Adam Newman, Rebecca Newman, and some of the other people who help run WeWork, really are also very comfortable having family ties play a big role at the workplace. So obviously, Adam and Rebecca are married. When you look at the origin story of the company is actually Adam and Miguel, the other co-founder, and then Rebecca sort of emerges 4 or 5 years in as someone who now has a co-founder title. This is something that, if you look at early stories about WeWork, this was not something they discussed, but she became more important as the company became bigger. And then beyond that, there, as we mentioned in our story this week, there's a lot of other family ties at WeWork. There are, Rebecca's cousin was the head of real estate for a long time. His parents ran the summer camp where WeWork used to have their summer retreats. Her brother-in-law, up until this past week, actually worked at WeWork as a vice chair. There were some others that were disclosed in the S1. A brother-in-law of Adams is someone who runs the gym and fitness offering at WeWork. There was another family member that was paid for some of the live events that they put on. It just kind of goes on and on. There are a lot of people who are personal friends of Adam who work at WeWork, including people who he knew from his childhood in Israel. So he feels, I think, a strong sense of loyalty to people. This is something his wife has described in interviews, and I think it comes out in how he chooses to do his professional dealings. And they were, at least at the top, very comfortable with having strong personal ties among the executive team and sort of the VP levels and above.
Still ahead, gender equality in private equity, or should I say lack thereof.
It's an important story, plus a new scale to measure wealth. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. Join us for Bloomberg BusinessWeek every day on the radio starting at 2 p.m. Wall Street time. You can also catch up on our daily show by listening to our podcast at Apple Podcasts, SoundCloud, and at Bloomberg.com.
And you can find us online at businessweek.com and through our mobile app.
We continue with our takeover of the finance section. It's private equity's world for now.
And speaking of takeover, those in the industry amount to a small group of the economic elite.
And they are mostly men. Bloomberg BusinessWeek's Sabrina Wilmer asked the question, where are the women?
I looked at the top 10 buyout firms by assets and tried to look at the number of women on these buyout teams that are actually making investments. And what I found is that there are very few women, and most of these firms only have 1 or 2 women on these teams that are made up of dozens of investment professionals.
We need to talk about the Wall Street or financial community overall. Are they kind of the same as what we see on Wall Street and at investment banks or the big banks, or is it worse?
Well, according to Preqin, which did a study earlier this year, it was mostly of asset managers. I don't think they included banks in the study, but they compared private equity to hedge funds and venture capital. And it looks like they have worse representation than even those industries which are known for not having women. And most of the women are in investor relations and marketing.
This is only going to change if the source of money decides that it's important. That's
right.
Where we saw it feels like, and again, you know this better than I do, that's where we saw some real movement on ESG. That's where we saw some real movement on sort of governance issues and fees and things like that. So far, It doesn't feel like the big limited partners are pushing that hard.
No, they're not. Like I said, they're being vocal about it and asking questions in meetings. And the board members are starting to ask more questions. But in ILPA, the Limited Partners Association put together, a checklist basically to get more information on diversity numbers.
One of the things that's really institutionalized this gender inequality is the fact that the money has just been so good, and investors overall have been pretty happy with what they've been getting back.
Exactly. And Jason, with bonds paying very little, big institutional investors, they are really desperate for the steady higher returns that private equity managers have historically been able to deliver.
Let's get more from Bloomberg's Hema Parmar.
If you look over 25 years and you compare how private equity has done compared to the public market, if you had invested money, what kind of return would you have seen from both? You would see a 13% gain from private equity versus about a 9% from the public market.
So better.
So especially over 25 years, quite good returns.
Okay, but is it so clear because they're not priced every day? There's not a lot of transparency. So can we take that at face value?
Right. So Warren Buffett earlier this year had mentioned a lot of some of the concerns with the space and said that, the math isn't always done in a very honest manner.
Yeah.
And so there are a number of concerns that people have with how these returns are calculated. And one of them is the math around what's called the internal rate of return, which is
it's
one
a key
of the
metric, right?
Yeah, exactly. It's a key metric that investors use to gauge how a private equity fund is doing and if they want to consider them to invest. And so the math around that basically is that the shorter the amount of time you can invest the investor's actual money, the better the returns will look. So sometimes what funds can do is they can take a loan, invest the leveraged capital into the investment, and then at a later date call the investor's actual money, put that to work, and then that shortens the amount of time, and it can pump up an IRR return by about 3 percentage points.
Because it's a shorter duration. That money isn't sitting for a long time, because private equity investments tend to be not always short-term, they're multiple years.
Yes.
I think that's interesting because we talk so much about all the dry powder that's sitting around. Mm-hmm. It's not actually sitting in the private equity offices, right? It's waiting till they find an investment and then they tap their investor pool.
Precisely.
So private equity has created a lot of wealth for investors and certainly for the individuals that created and run the firms. And as a result, some critics blame PE in part for exacerbating today's wealth gaps.
So Jason, to better evaluate wealth in our world, Bloomberg BusinessWeek's Peter Coy has more on a new index to pinpoint one's wealth.
A million is 1 times 10 to the 6th. So if you're just a simple millionaire, you're a 6. 1,000 is 10 to the 3rd power, so that makes you a 3. Most people probably watching this are worth more than $1,000, we hope. But so that gives it all the way down to -2, which would mean 10 to the -2, which is 1 penny.
Ah.
Yes. So everybody from a -2 on up to an 11 is on this wealth scale.
So 11 is a Bezos,
That's
Buffett
100
type
billion
wealthy.
bucks. Yeah, not Buffett.
Not Buffett anymore. That's
There's only
right.
2.
Right, 2
people
11s
in the world who right now are 11s. There was another one, Arnault, the French billionaire, but alas, he's below the 100 billion.
Now he's just a 10.
Now. Yeah.
Well, see, that's what I kind of love about it, right? You can you're growing up and you're thinking, man, I want to be a 7 or an 8 or an 11, right?
You're a 10.
Yeah. Well, thank you. But I mean, it does create this kind of metric for maybe
it's not intended
goals.
to engender jealousy. That's not the point. It's really just a scientific metric could be used for good or ill.
And so why do you think this is important?
Necessary? Yeah.
Did I say it's important?
All right, but this was a task.
All right. No, so seriously, I just feel as though it like any scientific measure, it gives you more specificity. It's just 1 order of magnitude rather than 3, which is what we get when you talk about a millionaire or a billionaire.
Well, and I think it is important going back to Elizabeth Warren because we are having a much more serious conversation about the haves and the have-nots, and it's not binary. It's not a have and have not world necessarily. Sometimes it feels that way in this age of income inequality, but ultimately when policy comes from all the politics, there are going to have to be decisions made about tax rates and when you reach certain thresholds, right?
And I like what you said about have and have not, because if you think about that, that's very much a binary world, one or the other. And yet there are gradations. There's some people, to somebody who's living on the street in a cardboard box, a person with $1,000 in the bank seems incredibly wealthy.
Up next, what to do if you crash your $3 million Bugatti.
And living on the edge, Michael Tenenbaum's advice on taking risk.
This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. You can also listen to us on the radio on Sirius XM Channel 119, also AM 1130 in New York, 1061 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, in London on DAB Digital, and of course on the Bloomberg Business app.
Well, taking risks is something former Bear Stearns executive and investor Michael Tenenbaum has managed most of his life.
He writes about it in a new book. It's called Risk, Living on the Edge. And in it, Tenenbaum talks about why that approach made him successful doing deals and literally swimming with the sharks.
when I went to Wall Street beginning of 1962, a couple of my classmates went to Morgan Stanley. They told me that their balance sheet, their net worth then was $5 million. Yeah, they didn't take risks. They once they were in a good club, they went there and they got business. So this changed over time as the commission structure eroded and the fat income and profits of Wall Street was attacked. They had to take more and more risk, and that's how they survived. And they put their money at risk in order to get transactions, block trades, for example. And risk then became, I think, almost a central idea of Wall Street and universal banks.
You took what many would say is probably the biggest risk of your professional career, which is you were in California at the time, to hang out a shingle, leave a very lucrative career at a big Wall Street firm, and start your own shop. You captured that moment, and it's a great moment between you and your wife, where you're looking out at the water, if I remember correctly, and she essentially knows you well enough at that point to say, "Listen, you got to do this. You're doing it. It's just a matter of how and when." What was inside you at that moment? What was in your head that convinced you this was the right move?
As I told her, when I was young, I used to like to swim. I was a lifeguard, and I dove off the low board a lot. Now and then I went up to the high board and dove off. And you'd walk out to the end, and you look down and say, "Why am I doing this? This is why." You didn't want to climb back down the ladder. Sometimes you did. And I just said it was like that. I was so tempted to leave. I hated the climate at Bear Stearns at the time in the 90s. But every time I got out to the end of the board, I looked down. And then finally, I said it was enough. And I think she was afraid I'd retire and hang around the house.
Got to do something. You got to do something.
Yeah, right. I took Fridays in the house, and so she would go to town on Friday.
Right. But what did you see that was the opportunity? Because, you mentioned Jerry Kohlberg. Jerry Kohlberg sort of sees something in 1976 with, two young colleagues, Henry Kravis and George Roberts. Fast forward, 20, 25 years later, you saw something, an opportunity around distress and around a sort of new form of investing in many ways. What was it?
A number of people have reviewed my book and said it has a lot of candor, so I have to be candid. I didn't know what the hell I was doing, okay? I just wanted to go prove I could do it.
Yeah.
And it's that simple. I mean, I hired two brilliant young men, right? And we sat around, we came up with these strategies, and trust me, they weren't good. But I was always a contrarian investor. And so I uncovered opportunities that were cheap. And I'd made a lot of money for wealthy people, and I would go to them and say, "Okay, we're going to buy this, and we want you to come in with us, and we'll take this share of the profits." None of them would do it. And so we did it, and we made a lot of money. And then I thought, dummy, you're a contrarian investor. What does that mean? Nobody else likes them, right? So I realized then I had to get a fund. You might say I got the memo very late.
No risk, no reward.
Well, that's what they say. And in another book that we recently read, Tillman Fertitta, the Landry CEO, also the owner of the Houston Rockets, he talks about all of those things. His book is called Shut Up and Listen, and it's a pretty powerful series of lessons. He describes where he's finding opportunities.
I've always used when things start slowing down as an opportunistic time. And even right now, I just bought a very successful restaurant company out of bankruptcy. So I'm seeing the opportunity out there. And it has nothing to do with the success of the individual restaurants. The individual restaurants are very successful. It's just the fact that, once again, the old Peter principle, poor management has done a very poor job in how they set up the capital structure of these restaurants, or they just did certain major mistakes at the corporate level. So therefore, it's a very opportunistic time for me, because that's how I've always grown my net worth, is in bad times. That's why you build liquidity and you build your balance sheet in good times, and you don't have to do acquisitions in your good times. You eat the weak in the bad times.
Right. Well, and you point out early in the book, you point out the importance of working capital and sort of having that money available, not just to run your business, but also to, as you say, take advantage of.
Why pay a huge multiple when everybody's trying to do it? it. Why not wait until there's a dip in the economy, which always happens, and you get a lot more for your money?
Well, before we wrap up, something we all know a little bit about, unfortunately, and that is fender benders.
Yes, we do. However, a fender bender takes on a whole new meaning when your ride is a $3 million exotic supercar.
Business Week Pursuit's Hannah Elliott has some advice for when you crash your Bugatti.
Well, you're probably going to call Bugatti directly and say, hey guys, you may want to send a truck, and then the car will be sent back to France.
That's what
repairs.
happens.
Yeah.
It's
and you're not going to see it for a while. It's going to be some months before you get it back.
I have to say, this is even more intense than maybe I thought it would be.
It's pretty intense. I mean, if you look at Lamborghini, they've got a program called the Flying Doctors, where they have some engineers that are trained by Boeing that they deploy anywhere there's a major crash from one of their valuable owners. And those guys will strip the car down to basically nothing, to the monocoque hub, and gradually graft in new layers, build new components on site, anything needed. Again, these, or Lamborghini will ship the car to the University of Washington in Seattle, and in their labs there, repair it there. So you're dealing with high-tech components that most dealers and shops don't have.
Hannah, what does something like this cost? And I'm always curious about the insurance side of it, right? I mean, do you actually file claims with your insurance, and do they cover this kind of?
That's a really good question, and it's a case-by-case basis. It's really interesting. Of course, none of the guys I spoke to really want to share with me, their insurance numbers and that sort of thing. Chris Singh told me insurance did cover the repair for the Bugatti that was hit by the Uber driver. Another owner told me if the damages are under $200,000 or so, he's not going to report the damages.
Under $200,000.
Yeah, because it's just not worth it proportionally. If you have a car that's a couple $1 million,
right,
it's really not worth it for what it might do to his insurance premiums. I spoke with the guys at Haggerty, and they too said, look, this is a really touchy subject. It's a case-by-case thing. To get a quote on this, you're talking thousands of dollars just per month.
Well, and it's a reminder that it's one thing to be able to afford a car, just to buy one of these cars, but the ongoing maintenance, even outside of a fender bender or some sort of crash, is massive, just taking care of these things.
It's incredible. For one example, the Mclaren F1, I spoke with Mclaren. This is a very special car that was built in the 90s. They estimate that just maintenance on the Mclaren F1 is $30,000 a year just to maintain. And they recommend each year sending the car back to the McLaren factory in England for oil changes, brake checks, the realignment, anything you might need on a regular car. On the F1, it costs so much more, and they're going to do it at headquarters.
Bloomberg BusinessWeek, it's available on newsstands now.
Also online at businessweek.com and on our mobile app. A loaded question. What's your must read?
It's private equity, of course. I have to say it. No, but it really is a great cover story and a series of stories looking at the growing influence of private equity. It touches so much of our lives. And we talk about the growing influence in Washington, why there aren't more women in the industry, so many different facets. It's a great read.
Well, I have to say, I've been looking at that industry for a long time. I learned a lot working on this and really taking advantage of a lot of the smart people we have here at Business Week.
Your must read?
My must read is WeWork. I think it is such a 2019 story in so many ways. We started the year thinking this was going to be the IPO, and then we scratched the surface a little bit, and whoa, as you would say.
And now I think it's going to be a 2020 story.
For sure.
It will keep on giving.
All right, more Bloomberg Television starts right now.